After a year of uncertainty, banks have finally something to look forward to in 2012. The Reserve Bank of India has cut the cash reserve ratio or CRR by 50 basis points to 5.5%. That, many believe, could be the beginning of an era where interest rates start declining, and that in turn could boost credit offtake. But things may not be that simple. Swati D'Souza tells you why.
India's wheel of fortune is slowly turning for the better. The latest IIP figures show a rebound in growth of 5.6%. Weekly food inflation is down at 1.03%, and the headline inflation figures have come down to a two-year low of 7.74%. And now, the RBI has slashed the CRR rate by 50 basis points. So if a slowing economy spells doom for banks in terms of rising NPAs and NPLs, then falling interest rates could coax industry to start borrowing once again. That is key to reviving up the economic engine.
Fundamentally, banks reflect the state of the economy, and what is expected is, with a reduction in inflation, easy liquidity, there is to be an uptick in economic activity. If there is an uptick in economic activity, we will participate in it.
The recent rate cut is expected to pump in an additional 32,000 crore rupees worth of liquidity into the system. But that is not enough to beat the acute liquidity crunch. That's because daily bank borrowings from the RBI have increased from 80,000 crore rupees in September 2011 to 1,60,000 crore rupees in January, and that's through the repo window. But this additional liquidity may or may not translate into lower interest costs for borrowers. That's because their cost of funds on the money they borrow for lending purposes may not come down on account of severe competition from several competing products like tax-free bonds. And if their cost of funds don't decline, then lending rates may remain firm.
There are competing, structures which offer a high rate of interest, so we will have to look at the market. And in my view, lending rates then depend on how the cost of funds move. So I think it's a little premature to really project about how interest rates will move.
The good news is that there is more liquidity coming into the system, with the government promising capital infusion for all public sector banks and even approving a 6,000 to 8,000 crore infusion into the SBI group. The bad news is that a rate cut may have come a little too late, at least for this financial year. According to rating agency ICRA, the banking system needs to expand credit by 2.13 lakh crore rupees in the last quarter of this financial year to meet the RBI's credit growth target of 16%. A report by ICRA states that while the target is easy to achieve, credit growth this year is likely to be lower than the 6.82 lakh crore rupees recorded last year.
Even RBI has scaled down its projection of credit growth from 18 to 16%. Take it because there are only 2 months left in the economy, so there is not enough lead time to absorb the excess liquidity when it comes, at least for CapEx.
Indian banks have so far been able to avoid any pressure on their net interest margins because they passed on additional interest costs to customers. But with interest rates looking like they will head downward, the pressure on margins and hence profitability is inevitable.
So we are looking at a situation where spreads are going to drop. We expect that the net interest margins in themselves will drop by about 18 to 20 basis points. We are looking at net profit margins also coming down materially. We look at the NIMs may be coming below 3%.
As net interest margins fall, banks will have to shift focus from profitability to efficiency once again. According to the RBI, the net interest margins of Indian banks are far higher than those of banks in some emerging markets, despite taking into account priority sector lending. And the regulator has stated to sustain high and inclusive growth, Indian banks need to raise the level of domestic savings and channelize them into investments. That means they need to offer attractive interest rates to depositors and reduce rates charged to borrowers. To put it simply, they need to lower their net interest margins. And that can only be done by bringing down non-interest expenses like wages and staff costs, transaction costs and provisioning expenses. Enter technology.
Through technology, through well-trained sales and service resources in our branches, we will be able to give a far superior deal supported by attractive rates of interest.
There will be more focus on financial inclusion. I think there will be more technology advancement in mobile banking. And once I think interest rate starts going down, and I hope it will start happening from maybe somewhere from March, then I think banks will all look towards funding more retail as well as corporate.
The biggest reason why banks need to get moving faster on technology adoption is the fact that banking is becoming more complex. But risk management systems have not really kept pace with the changing times. With banks across the globe gearing up for Basel III, Indian banks need to put their best foot forward sooner rather than later.